Thanks for joining me this month for my October market update. This month, I'm introducing a new format because I wanted to simplify my video content to make it easier for you to digest. Each month going forward, I'll be bringing you the top 5 things I think you need to know this month. There's a lot of market and economic news out there, and in these videos, I want to help you understand how to make wise money decisions by staying informed in 5 minutes or less. For those who are new to my YouTube channel, I'm Valerie Leonard, founder and CEO of EverThrive Financial Group, and here are my top 5 things for October. First, I've been getting a lot of client questions about the impact of a government shutdown on the stock market. We narrowly avoided a shutdown on October 1st with a 45-day stopgap bill. And yes, it's possible we could face a potential shutdown again. So we're going to be watching the November 17th funding deadline closely. But even if we do face a shutdown, history tells us that markets are resilient. In the 2018 to 2019 shutdown, the S&P 500 was up more than 10% by the end of the 34-day event. If you go all the way back to 1976, as you see here, you'll see that losses tend to be minimal and short-lived, and pulling out of the markets during a shutdown can prevent you from realizing gains when we do rebound. So there's no guarantee, of course, that markets will react exactly the same way the next time, but history does tend to rhyme a lot. Second, even though we're all worn out by market volatility, it's important to remember that markets are still in a technical uptrend. It is extremely common for the markets to give back a significant portion of the prior gains before resuming the primary uptrend. So the fact that markets haven't rebounded back to all-time highs is really unsurprising. This chart of the S&P 500 goes back 20 years, and as you can see, the trend is still your friend. And at this point, we've simply retraced a fair portion of the gains we saw from early 2020 to the end of 2021. You can also see this chart shows that the S&P 500 has been above its 200-week moving average, which is that red line that isn't as volatile as the other lines on the chart. So we're above the 200-week moving average despite a bumpy third quarter. So if you go back to 1950 and you study the S&P 500, there were only 13 years where the months of August and September were negative, with this being the 14th year. And in looking at those prior 13 cases, 12 out of 13 of those years had a positive fourth quarter with an average fourth quarter return of 9.24%. So all signs are pointing to a positive fourth quarter. And of course, anything could happen, but the bottom line is that there's no reason to panic. Trust me, I know that market volatility is exhausting. Even the pullback we've seen since August is still classified as a normal market correction. So there's no need to panic. The headlines about our divided government, our U.S. debt levels, wars throughout the world, and also the economic slowdown can certainly make anyone question whether staying invested is the best path forward. Just remember that we have experienced many tumultuous times throughout history, and markets have continued to be resilient. So when you invest, patience is key. Third, you may be wondering about the status of the US dollar and whether or not it will continue to maintain the global reserve currency status. So the talking heads, the major news outlets, they certainly like to drum up speculation, and this type of banter obviously sells. Many of the doomsdayers are selling a product like gold, for instance, and they know that fear causes people to act irrationally. As humans, we like predictability, and we don't want anything rocking our world as we know it. So the fact of the matter is the dollar is still secure. The US still is the largest economy, and everyone throughout the world wants access to the US economy. And so when fear spikes throughout the world, where do people go? They go to the US dollar. So take a look at this 20-year chart of the dollar. Sure, it's down a bit from its peak in mid 2022, but it's still as strong as we've seen throughout the last 2 decades. Also, keep in mind that there's still no viable alternative to the dollar. If you consider the euro or the Chinese yuan as alternatives, for instance, you realize that they just can't compare. So for one, the Chinese yuan is controlled by the Chinese government, not their markets. So why would anyone in their right mind take on the political risk of converting all their assets to it. Additionally, the US, despite all the nonsense in Washington that we see from day to day, is still more politically and economically stable than the Eurozone. The bottom line is this chart tells a story, and markets aren't flashing any warning signs at this point. Fourth, on the consumer front, we are still seeing some concerning signals that continue to flash caution lights as a warning for a potential recession. So, consumer confidence, for instance, declined for the second month in a row in September. We measure that by both the Conference Board's Consumer Confidence Index and also the University of Michigan's Consumer Sentiment Index. The flip side of that is that consumers are still spending. So in August of this year compared to August of last year, spending rose by 5.8%. So there is a concern here, primarily because consumer debt continues to remain at an all-time high with more than $1 trillion in credit card debt being carried by Americans. So this is something we look at closely. Finally, number 5. The jobs report were strong in September. Inflation has crept back up, and the Fed is probably not likely to let up on interest rate hikes in the near future. So this brings us to the bond market. There's concerns there, especially when you watch U.S. Treasuries. Just so you know, the Treasury market is the foundation of our financial market, and it's had trouble finding its footing in the past few weeks. So why is this? I think that the market doesn't really buy what the Fed is selling at the moment. So since the Fed didn't raise interest rates this past month, the market did it for them. And when Treasury rates rise, the prices of those Treasuries fall. So having said this, it wouldn't surprise me if U.S. Treasuries were to rally soon because we've seen such a sharp decline in prices. Also, with almost every major asset class and sector negative for the quarter, there really hasn't been any place for investors to run other than cash. Thankfully, cash and short-term cash alternatives are paying excellent rates at the moment. So there are conservative options out there for people who don't want to take risk. But even in these cases, I have seen these market and economic patterns before. And these types of ups and downs have historically been temporary and common. Of course, the markets are resilient by design. Heads up that we have another video coming soon with important investment and tax related actions that you can take between now and the end of the year. To make sure that you get notified as soon as possible, hit the subscribe button on YouTube. I promise next month I'll try to get the video under 5 minutes. But thank you for joining us, and we will see you in November.